The stock market is definitely one of the best ways to invest into your future. And unfortunately, it is still highly underused by the majority of the public. Long-term investment is also one of the safest ways to accumulate wealth passively over the course of your life.
What are the best ways to invest long-term? How do you set up your own investments? And which funds do we label as the best ones to invest in? We'll also tell you why you should definitely start as soon as possible. Just hang on and find out.
Hey guys, welcome to another video. Long-term investing is actually one of the safest ways to accumulate wealth during your lifetime.
So over the past 100 years, the average stock market growth was about 7% including inflation. It would be 10% without inflation. And that's definitely better than losing 1 to 3% every year to inflation on your bank account.
When looking at long-term investment, it should always be your goal to build up a very well-diversified, worldwide ETF portfolio. But what exactly are ETFs?
So ETF stands for Exchange Trade Fund. And you can basically imagine it like a big collection of many different companies' stocks. For example, the S&P 500 is a very common ETF.
In long-term investing, you have two approaches to it. Number one is really safe, and the second one is a little bit more daring. Let's start off with the first one, the safe one. You basically only invest in ETFs.
And you can do that very easily. You select a broker, and on the first of every month, you just automate a monthly fixed payment that is roughly about 10% of your income every month.
Always remember you have an annual average return of 7%, but many ETFs can skyrocket above that, do numbers like 13-14%. So we would actually always advise to always invest into ETFs.
Also, it is very easy to invest long term because it's very automated and it doesn't take any time. You select it once, you set it the payment once, and you're done for the rest of your life. You can change stuff, but basically that's it.
So you can basically retire at an old age and just cash out. And in the meanwhile, you can just completely forget about investment.
So let's get into the meat and potatoes of the more exciting way. With this variant, you invest a minimum of 25% of your money only in ETFs.
The rest of the investment portfolio you have, or the budget you have for your portfolio, you can then invest in stocks, in individual company stocks trying to beat the market. And beating the market means that you want to achieve a higher return per year than 7%.
It is also extremely important to mention that before you buy any stock of any company, you should really do a thorough research about the company's stock.
And investing in stocks is really good if you're young, because you have less risk to carry. The worst thing that's going to happen to you is that you lose a little bit of money.
So guys, you've watched the video so far. If you like the content, please make sure to like and subscribe if you don't want to miss out on any future videos. But let's talk about the ETFs you actually should invest in.
And that is actually dependent on the size of your budget. First of all, we have the small budget.
So with the small budget, if you invest using the safe method, you invest 100% of your portfolio in the MSCI World ETF. And this ETF has over the last 30 years, 13% annual growth.
Then we have of course, another possibility if you have a bigger budget is that you split your ETF investment, which means you take one part, for example, 70% you invest into the MSCI World, and the rest of your money, like the remaining 30%, you invest into the MSCI World Emerging Markets, which had also a really good growth over the last 20 years, which are around about 8%.
So let's talk about the numbers.
Well, if you would, for example, invest over a time span of 30 years with an average annual growth of 13%, and let's say you start with no money as a fixed payment, but you use like $250 each month, then you will, over the next 30 years, accumulate a wealth of $930,850.77, and that's a lot of money.
So if you use these numbers, let's say you're 20 now and you start investing for 30 years. So with 50 years old, you would almost have $1 million to play around with.
So let's talk about our honorable mentions of long-term investing. And one of these would, for example, be real estate. After you've paid off a mortgage on, for example, an apartment you've bought and you're renting it out, after you've paid it off, you will have genuine cash flow each month.
So our other thing would be gold. Gold is a very well-known natural resource that has kept its value over the last 100 years, and it will definitely continue keeping its value for the next 100 years. This way you won't lose your money to inflation.
Now, let's take a look at long-term investing from an entrepreneurial perspective. First of all, long-term investing is really good for everybody, and everybody should do it, especially if you're a normal employee.
So for example, if you're a normal employee, you save money every month, but you will only be wealthy at 65, basically at retiring age. It depends when you start. But for example, you save up all your life, you could technically die before retiring age.
So it should be the goal as an entrepreneur to make a lot of money in your prime and use that then to retire rich.
So here are our top 3 investment tips for beginners. It is very important that you diversify your investments. Have some cash laying around, have a lot of it in the stock market, also have a real estate portfolio, maybe some natural resources, or whatever else you want to have.
The second most important tip would be that you have to understand your investment. You have to understand the branch, you have to understand the market, and you have to understand what drives buyer decisions in your field and what could maybe affect the stock positively or negatively.
Number 3 is also extremely important. Keep calm, especially during financial crisis. The stocks and your portfolio, everything might go down, but after that, after a time, you can buy in cheaper, and then you can also take up the upswing, and after time, your stocks will always go up.
So a short TLDR, don't panic sell. Down in the video description we have mentioned some of the best ETFs you should definitely check out because they have also great return rates.
If you like this video, feel free to check out the many different other videos we already did, and don't forget to like, subscribe and hit the bell notification if you don't want to miss out on any future videos. See you soon, guys.